Hello everyone, welcome to this channel. I am William. Thank you for being here. Today we'll cover how to audit anti-money laundering program. Money laundering isn't just a plot from a crime drama. It's a $2 trillion annual problem, and regulators are handing out record fines for weak controls. Your job as an auditor? Find the cracks before the regulators do. By the end of this session, you will know 1. The core pillars of any AML program. 2. How to test transaction monitoring and alerts. 3. Key red flags in customer due diligence. 4. And a checklist for your next audit. Before I start, please feel free to subscribe to this channel and watch this video until the end, as this will help us to grow the channel so that we can produce the e-learning videos continuously. Let's begin. First, you cannot audit AML without knowing what good looks like. The baseline changes by jurisdiction, but globally, most regulators follow FATF's 40 recommendations. For the audit scope, which regulations apply? Bank Secrecy Act, EU's 6th Directive, Local Financial Intelligence Unit rules. What is the institution's risk appetite for money laundering? Critical first step. Obtain the last regulatory exam or audit report. Have prior findings been fixed? If not, that's your starting point. Also request AML Policy Manual, Risk Assessment, Institutional and Customer Risk Ratings, Training Records, and the Suspicious Activity Reporting Log for the last 12 months. Without these, pause the audit. Seriously. Now let's get practical. CDD is the front door. If it's broken, everything else fails. Test 1. Opening accounts. Take a random sample of 25 new accounts from each business line. For each, verify. Was a beneficial owner identified for legal entities? Ownership over 25% is the typical threshold. Did the onboarding documents match independent sources? For example, utility bill, passport, company registry. Test 2. High-risk customers. Ask for the list of PEPs, politically exposed persons, and anyone from sanctioned countries. For each high-risk file, is there enhanced due diligence, EDD, on file? Was a senior manager's approval documented? Are reviews done every 6 months, not annually? Red flag. If you find 3 or more high-risk files missing EDD, that's a material weakness. Escalate immediately. Test 3. Sanction screening. Take 25 random wire transfers from the past month. Run the names and countries through free OFAC or EU sanctions lists yourself. If the bank's system missed a hit, you've found a critical gap. This is where AML lives or dies. Transaction monitoring systems generate alerts. But too many false positives means analysts get numb. Too few alerts means you're blind. Audit step. Ask for the last 90 days of all alerts. Then test. 1. Thresholds. Are they set properly? For example, if cash deposits over $10,000 trigger a SAR, but your bank only monitors over $50,000, that's a policy failure. 2. Alert volume. Pull 50 closed alerts. 25 cleared, 25 sent to SAR. For each cleared alert, read the analyst's note. Does it actually justify why it's not suspicious? Generic notes like "customer seems fine" are failures. 3. Timeliness. From alert creation to closure or SAR filing, what's the average? Regulators expect 30 days for most cases, faster for urgent ones. Scenario test. Find an account that shows structuring, multiple cash deposits just under the reporting threshold. Did the system link them across dates? If not, your monitoring logic is flawed. Also, look at look-back periods. Some systems only scan recent 30 days, but money launderers operate over months. The audit standard is, can the system detect patterns over 6 to 12 months? If no, recommend a parameter change. A SAR is the institution's formal alert to authorities. Auditing SARs is delicate. You aren't judging the suspicion itself, but the process. Key tests. 1. Completeness. Do SARs include all required fields? Suspect info, transaction details, narrative of suspicion, supporting documents. Sample 10 filed SARs. 2. Timeliness. From detection of suspicious activity to filing, is it within the required time frame? Typically 30 calendar days, 15 for some jurisdictions. 3. Quality of narrative. The why must be clear. Bad example, transactions unusual. Good example, customer's account received three $9,900 wire transfers from unrelated offshore shell companies, then wired 90% to a crypto exchange. No business rationale. Confidentiality breach test. Ask compliance. Who internally can see SARs? If anyone outside the AML unit, legal or audit without a need to know, that's a violation. In fact, in some countries, revealing a SAR's existence is a crime. Check access logs. Finally, request the SAR feedback log from the Financial Intelligence Unit. Have they criticized late or incomplete filings? If yes, that's a board-level risk. Regulations require that AML controls be independently tested. Your audit is part of that. But also audit the AML officer's role. Questions to answer. Does the AML officer have direct reporting to the board, not just legal or operations? Is there a budget proportionate to risk? If the AML team has 2 people for 50,000 accounts and high cross-border volume, that's a red flag. Staff qualifications. Pull training records. Has every analyst completed accredited AML training in the last year? Look for retaliation risk. Interview 3 analysts off the record. Ask, have you ever been pressured to close an alert without investigation? If yes, document it. That's a culture failure. Also, test management information, the reports the board sees monthly. Do they show key metrics? Number of alerts, SARs filed, average closure time, backlog? If boards only see high-level assurances, that's a governance gap. From real AML audits, the top 3 findings are: 1. Delayed SAR filings. Over 30 days old, no escalation. 2. Weak EDD for PEPs. Missing source of wealth documents. 3. Untuned monitoring scenarios. Too many false positives or thresholds set too high. Your final report should not just list failures. For each finding, give a pragmatic fix. Adjust threshold X from $50,000 to $10,000 on product Y. Mandate refresher training on SAR narrative, writing by Q3. Implement monthly aging report for alerts over 20 days. Before you leave, here's your 5-item pre-audit checklist. Get prior audit and regulatory findings. Map your institution's risk assessment. Sample 25 CDD files, focus on high risk. Run your own sanctions test on 25 transactions. Review SAR timeliness and narrative quality. Remember, money launderers are patient. Your audit must be sharper. You are not just checking boxes, you are protecting the financial system. That's the end of my sharing today. If you found the e-learning video is useful, please feel free to subscribe and share it out with your friends and colleagues. Thank you and have a great day ahead.